You ever wonder how a tiny AI-driven company trading under a buck could quietly shake up a multi-billion-dollar security and automation market? No cap. That's the kind of move that gets lit when the market finally notices. And what if the market is only just starting to price in the real value of AI-enabled logistics and robotics? Straight up, that's a next-level setup. Here's the kicker. At 60 cents a share, the market is criminally undervaluing this thing. It's priced like it's worth less than its cash and revenue. That's wild, because this is the kind of big bag that can pop off fast. When the market finally wakes up, the move can be fast, sharp, and brutal. For anyone who's late to the party, buckle up. This is beast mode territory. Here's the promise. By the end of this video, you'll know what the company actually earns, how it's moving toward profitability, and where credible analyst frameworks could take the stock next. Let's get it, because this is a money move. We're talking real revenue, gross profit expansion, cash on the balance sheet, and EBITDA trends, all stitched together into a valuation story that's numbers first. And if you've been watching CNBC or Reuters lately, you know the market is obsessed with AI winners. High key. AI is the mainstream now. So the question becomes, is this a real AI story? Or just another small cap headline chasing the hype train? Real talk. We don't buy the hype. We buy the data. Before we jump in, welcome to KMI, delivering sharp, data-driven insights on emerging tech and high-potential U.S. market opportunities, designed to help you spot the next big winner. Now, let's introduce the company. This is Guardforce AI, trading on the NASDAQ under the ticker GFAI. Today, the stock is trading around 60 cents per share. That's bargain bin energy, but the upside is insane. If you're asking why this one, start with the business model. GFAI operates as a global integrated security provider, blending secure logistics services, AI platforms, robotics as a service, and smart retail AI applications. That's multi-engine revenue, and it's next gen. It's not just one business, it's multiple revenue engines, which means multiple chances to surprise the market. That's a big upgrade waiting to happen. Companies like Amazon, IBM, Honeywell, and even Alphabet's Google are investing billions into AI and automation. That trend creates a massive runway for smaller players like GFAI to capture niche market share. That's a fat stack of opportunity. In the security and automation space, competitors include major names like ADT, Johnson Controls, and Motorola Solutions, while the robotics side competes indirectly with players like iRobot, Boston Dynamics, and even Tesla's robotics ambitions. This is the wild ride zone. The company reported full-year revenue of about $36.3 million in 2024, essentially flat, but slightly positive growth year over year. It's low-key solid. That revenue produced about $6.3 million in gross profit in 2024, up roughly 16% from the prior year, with gross margins climbing to about 17.2%. Now, that margin number might not look impressive at first glance. But here's the key. Margin expansion in a low-growth environment is evidence of operational improvement. That's street money proof, not hype. What does this tell us? Two things. First, GFAI is improving profitability at the gross level, trimming costs and optimizing services. Second, margins are expanding despite flat top-line growth, a hallmark of operational discipline. Even better, the company reduced its selling, distribution, and admin costs from about $12.7 million to around $10.1 million in 2024. That's meaningful, because it means they are cutting waste, not cutting growth. That's big brain efficiency. Net loss still exists, about $5.9 million, but that's an 80% reduction year over year. That's a major upgrade in the loss column. And it's hyped. Cash position? As of year-end 2024. GFA, I had approximately $23.4 million in cash and equivalents, more than enough runway to fund innovation and strategic expansion. And when you subtract debt of about $2.9 million from cash of $23.4 million, you get roughly $20.5 million in net liquidity. That's not just cash on hand, that's financial breathing room. Now let's break down what this means in per-share terms. At 60 cents per share, the market is valuing the entire business at a fraction of its cash plus its revenue base. That's why this stock can move quickly, because the market can re-rate it without needing huge revenue growth first. It only needs a few positive catalysts. So let's talk catalysts. First, AI revenue scaling. GFAI launched DVGO, an AI-powered travel planning agent. This isn't fluff. It's a new revenue stream positioned to expand margins as adoption grows. Second, a higher margin service mix. The company reports a shift toward higher margin clients, and margins moved from about 14.9% to 17.2%, signaling improved profitability. That's cheddar growth. If they can push gross margins toward 20% plus, the valuation story changes dramatically. Third, cash positives scaling. Cash balance rose from about $21.9 million to $23.4 million, showing funding runway for R&D, not desperation. That's bag-secured energy. And in small caps, dilution is one of the biggest killers of shareholder returns. On the industry side, AI adoption in retail automation continues accelerating. Guardforce is uniquely positioned with deployed solutions across 25,000 plus stores, a ready market for upsell. That's big-time scale. On the financial side, adjusted EBITDA is improving fast, from negative about $1.8 million to negative about $0.7 million. That's operational progress. If this trend continues, break-even EBITDA could be within sight. And once a company gets close to EBITDA break-even, investor sentiment shifts fast, because the market begins to believe the business model is real. That's big energy, because sentiment moves markets. Now you might ask, where are analysts on this? Well, you won't find a huge number of ratings yet, but you will find consistent coverage from finance platforms like Bloomberg, Yahoo Finance, Seeking Alpha, FactSet, Motley Fool, and NASDAQ.com. That's street cred in the data world. When outlets like CNBC or the Financial Times highlight AI adoption trends, or when Reuters reports on AI security automation growth. Those stories don't just create hype, they create capital flows. Now let's talk plausible future price levels. At the current 60 cents, a conservative target over the next 6 to 12 months is $1.20. That would imply a re-rating based on continued margin expansion and EBITDA narrowing. Upside here is about 100%. A base target would be $2. Possible if AI revenue scales and gross margins approach 25%. That's roughly 233% upside. A bullish target could be $4 or more, but only if robust AI demand growth takes hold and EBITDA turns positive. That's roughly 567% upside. That's moon talk, but it's possible. Here's how the numbers support these targets. Market cap today is tiny, giving room for upward multiple expansion. Revenue base is around $36.3 million. Not huge, but stable with potential AI growth overlay. Gross margin expansion from about 15% to 17% shows working leverage. EBITDA trend is improving significantly. Every dollar less in negative EBITDA supports a higher valuation multiple. In plain terms, if GFAI reaches positive EBITDA and projects double-digit gross margins, investors will value it more like a growth tech, AI play, not a legacy security services provider. That's a major upgrade in perception. That's the key. Now let's be honest. Risks are real. Execution risk is real. Top-line growth was essentially flat in 2024. Continued net losses are still a concern. But here's the key. Risks don't erase probabilities. They frame them. And the current trend of margin improvement plus cash runway, that's betting smart, not gambling. Probability favors margin expansion, longer runway, and AI adoption momentum, which together support upward re-rating possibilities from roughly 100% to 567% plus, depending on execution. If you want to see more deep dives like this, hit like, subscribe, and drop a comment below. What price target do you think Guardforce AI actually deserves in 12 months? Let's get it. Stay sharp, stay data-driven.